In this video, we're going to look at Etsy. Etsy is an e-commerce website that focuses on handmade or vintage items, and they also have a lot of craft supplies. And what I do in my videos is I try to estimate the value of a stock using my discounted cash flow model. And then we look at the financial ratios of the company and compare them to similar companies. I do this with you throughout the whole video, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $12.2 billion. That's the value of the company according to the stock market. And let's get their stock price. It's $102.71. So one share is roughly $103. Now let's pull their actual free cash flows. And free cash flows are the cash that's remaining after operating a business minus large capital expenditures. And the way you value a company or an asset is you estimate the future free cash flows, then discount that number back to today's value. And that's what I'm doing in this video. We also need the net income, which is a profit and loss according to the income statement. And we're going to put 4 years of that into the model. And we also need the revenue, which are the sales. And you can see that sales have been increasing quite a bit each year, so that's a really good sign. They went from 365 million all the way up to 818 million in 4 years. So in 2016 they had negative net income and negative free cash flow, but after that it's been positive. So we should get a good value for the stock. Let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. So they pay $24 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to liabilities. Current debt, no current debt. Long-term debt of $785 million. That's debt due after 12 months. And they pay 3% interest on their debt. According to the income statement, they don't pay taxes. So the cost of debt is 3.1%. To get the cost of equity, we need the beta. And that's the volatility of the stock. And their beta is 1.67. So the stock moves about 1.7 times the market. So the market goes up 10% in the year, this stock should go up 17%. And if the market goes down 10%, this stock should go down 17%. Let's look for their current assets. And we need this information when we calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. And we'll get the current liabilities, and this is how much money the company owes within the next 12 months. That's $189 million. We also need their equity. That's assets minus liabilities. That's $406 million. And we need their EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's $89 million. Let's look at the capital structure. So the cost of debt is 3.1% and the weight of debt is 66%. The cost of equity is 15% and the weight of equity is 34%. So the weighted average cost of capital is 7.2%. That's a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. We'll get a value of the company of $6.2 billion. We divide that by 119 million shares, and we get an intrinsic stock price of $53. It's trading at 103, so it's trading at a 96% premium. So it's a sell according to the model. Let's see what Simply Wall Street has. They're at 104, so they're saying the stock is worth what it's trading at. The free cash flows that I estimated are more than the previous cash flows. I used my most conservative model. The other models came up with a much lower value. Let's look at the historical stock price. It looked like it was flat for a few years, but it's been on an upward trend, and then it took a real major upward trend the past few months. So it seems like the stock is almost at its all-time high. So that's why my model says it's worth $53, because it's just been driven up so much, the price. So the stock price can trade much higher than intrinsic value. It's really what people are willing to pay for the stock. So if a company, according to the financials, it's worth $50, that doesn't mean investors think it's really worth $50. They may feel the future of the company is worth $100 or $200, or whatever they feel it's worth, they're going to pay for that. Just like buying any product. If you think it's worth X amount, you're going to pay X. If you don't think it's worth that, you're not going to buy it. Let's look at the financial ratios to get more information. So the PE is way out there, 127. That's a terrible PE. That's price of stock, which is 103, over earnings per share. And earnings per share is net income, which is $96 million, over shares outstanding, 119 million. So they're not even providing $1 per share, and the shares are over $100. That's why the PE is 127. I like to see below 15. Price to sales ratio 15, that's price of stock, the 103, over sales per share. And to get sales per share, it's revenue, and we use the 2019 revenue of 818 million, over shares outstanding 119 million. So it's $7. And then the ratio is stock price over sales per share. That's how we come up with the 15. So that means investors are willing to pay $15 for $1 of sales. So in that category, they're not providing a good value. Price to book of 30, also another bad ratio. That's price of stock, 103, over book value per share. And their book value per share is calculated by taking their equity. Remember their equity, the 407 million? That's assets minus liabilities in the balance sheet, divided by shares outstanding. So the book value per share is $3.42. So if they went bankrupt today, each shareholder would get about $3.50, even though you paid $103 for your share. So that's why the price to book value is so terrible at 30. I like to see 3.5 or below. Their current ratio is almost 5. That's current assets 921 million over current liabilities 189 million. So they're sitting on a lot of current assets. That's too high. They don't need that much current assets. And you can see on that balance sheet, the 921 million of current assets, it's mostly cash. So they're just sitting on a ton of cash. So they should be doing more with the cash, like investing in their company. They have a really good ROE of 24%. So ROE is net income, that's 96 million, over equity, the 407 million. So they can provide almost 25% return on equity. So in this ratio, they're doing really well. Interest coverage ratio of 3.6, that's EBIT, earnings before interest and taxes, over interest expense, 24 million. So they can cover their interest expense without a problem, so that's a good sign. And they're a little leveraged with 66% debt. The best way to look at ratios is to compare them to similar companies. I've done videos on Momo, JD, Amazon, eBay, and this is Etsy. And if Etsy's numbers are in red, they're worse than the average. If they're in green, they're better than the average. So you can see they're worse than the average in pretty much everything, except current ratio, and they're actually not that good in current ratio because they have too much. So they have the worst PE of all the companies, the worst price to sales, the worst price to book. Even though they have the highest current ratio, I would say that's the worst because they're sitting on so much cash. Everybody's around 1, which means they're running a pretty efficient operation. They're in the middle in ROE. They're not the worst in that category. In terms of debt, they're the second worst in debt. They're 66% and eBay 73%. And they're on the smaller side of the companies. So it looks like it could be a pretty risky stock to invest in. But if a stock is overvalued, that doesn't mean you can't make money. You just have to get out before it drops. But let me know what you think of the video. Leave a comment. Thanks for watching.